Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by J.R. Johnson LLC, specialists in multifamily restoration and repair work. Gantry Incorporated, the nation's largest independent mortgage banking firm. Butler Exchange Group, offering 1031 tax-free exchange services. And Forensic Building Consultants, experts in the diagnosis, repair, and preservation of multifamily assets.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. And today we have with us Charlie Kokernak, director of Gantry, Inc. I know we've had Blake here before from Gantry. Maybe for people that aren't familiar, give a little rundown on what Gantry does and kind of your role. Then we'll talk a little bit about the changes that we've seen since last 6 months of 2022 in terms of financing, what lenders are in, which ones are out, and volume and things like that. So,
of course.
First off, thanks for coming. So, yeah, give a little history on, kind of you're in real estate and where Gantry plays.
Of course. Well, HFO and Greg, thank you very much for having me.
Yep.
So Gantry is a mortgage banking firm. We're based here in Portland. We have offices all throughout the West Coast, though, as far as our presence goes. We have a number of correspondent lenders that we have deep relationships with on the life insurance company side, but especially in the last couple of years as markets have shifted, we've been working with banks, credit unions, debt funds, CMBS lenders, and agency lenders as well, whatever fits the bill for the transaction needs.
Now, is that change, is that regional? Are you seeing, is everybody in Gantry kind of seeing that same thing up and down the West Coast? Or is this more specific to the Pacific Northwest in terms of the changing of the life companies and some of the regional banks playing?
Good question. So it really is kind of it's a national shift. And as people have sought yield throughout the cycle really starting back in 2009 and 10, so 10 or 12 years in, they have looked at different markets. And as markets have been tapped into, Portland, Austin, Nashville, for instance, maybe slightly higher cap rates, they've flooded into that market on the equity side, and the debt has been there hand in hand to follow.
Right.
So, but absolutely, the trends we're seeing are on a national basis. Gantry does have a presence therein, although we really do have a regional focus. So our offices are as far north as Seattle and Spokane, and then as far south as Orange County, and then east we do have an office in Buffalo, New York, which is kind of an outlier. We do have offices in Las Vegas and Phoenix, but just to kind of give you an idea, we do cover the gamut on the West Coast, although have provided loans in effectively all 56
states. Okay. But a deep knowledge of what's going on the West Coast.
Absolutely.
And not just multifamily, though that's our audience. It covers all product types. And
correct.
Gotcha. So let's talk a little on the multifamily side. We're sitting here in the middle of 2022. We all, inflation, the 10-year and rates. What have you guys seen the last 60, 90 days in terms of kind of the changing of the players on the lending side? And then we'll kind of talk a little bit about underwriting and stuff.
Of course. Yeah. This is a very unique time in the capital markets and the investment market as a whole. Big difference from, the downturn we had with the great financial crisis is that was caused effectively by a real estate bubble. This one, the real estate market will certainly feel what's happening on a kind of larger economic basis, and certainly not here to talk about a deep dive into the economics of where we are, but just comparing where we were last year with our 2021 numbers to year-to-date 2022. Last year we closed about 60% of our business with life insurance companies. And those life cos are known for long-term fixed-rate financing. Typically, there is no personal guarantee needed. They have a very simple structure, few reserves, and borrowers typically like that as it aligns with that long-term hold.
Now, are they typically going to, flight to quality? That's always been kind of, when we talk and, with the life companies, they're more of if it fits in that box, which typically is a higher quality. They may not be the player in that Class C older project. Did that change last year, or was it just more volume of those?
No, that's a great question. So, Gantry specifically has 36 or so different life companies, and it varies by office which one we might have an exclusive relationship with. But they go all up and down the spectrum. Typically, they do align themselves with the higher end of the market as far as quality or just leverage in general. They are known for being generally lower leverage, but they're looking for, set it and forget it type 10-year, 15, maybe even 20 or 25-year fixed mortgages. They're looking for consistency of income. That said, there are life companies that we work with who do finance properties who I wouldn't say are higher risk, but they have structure therein to balance. And maybe they'll take recourse instead of typically having non-recourse. But really, it spans a gamut of all different property
Got it.
types
Okay.
and acquisition profiles.
And then what about on, in 21, was there more, it was, again, we talked about on the leverage side. I know a lot of it, the leverage constraint on the leverage side now is the debt coverage ratios, we get higher rates.
Right.
But, are you seeing that with all the different kind of lenders, or is there some that had more of effect in terms of peeling back down the amount of leverage?
That's a great point. So, what really is driving transactions today we're seeing on the debt side is not value, but cash flow.
Right.
And that's going to translate to, as you mentioned, debt service coverage. So last year, as I said, we did about 60% with our life companies. 2022 to date, we've closed about $2.8 billion, and about half of that is with our life companies.
Okay.
Some of that may have been forward rate locked from last year, locking in a rate maybe late 21 and then funding middle of this year.
Which they'll do. That's
Yeah.
the one thing about life companies. They will get a little bit more creative on the rate lock and forward. Yeah. Okay.
This year, though, we've done about twice the bank business that we did last year on a
Okay.
year-to-date basis, and then triple the amount of bridge business. So, bridge could be anything from maybe even a bank or life company offering a bridge loan placement,
Got it.
but typically is aligned with debt funds today, whether that's a discretionary debt fund who maybe has capital from a high net worth individual or a number of them, or maybe a group who is securitizing that loan placement after close. And so we've seen a lot more opportunistic purchases to start 2022. Now, I don't know that the back end of 22 will be reflective of.
I was going to say,
first.
this sounds a lot like what we saw in the first quarter.
Correct.
What are you seeing now with debt funds? The last, since we've seen this massive, increase in rates, are you seeing them going away? Are they changing terms?
Well, I think lenders as a whole, and you alluded to it before, is what is driving these transactions.
Right.
Underwriting fundamentals are not going out the window. We're not finding ourselves in a situation where lenders may be saying, well, we're not going to look at the income of the property. We're going to be less concerned with the tenancy. Let's just fund this and figure it out later. They're still holding to their guns, so to speak. So whether that's we need to have a certain amount of debt coverage, and on the bridge side. In general, the question always is, if I'm bridging you from today to
Right.
tomorrow's scenario, how do I as a lender know there will be somebody there to effectively take me out, to pay off this loan?
Right.
And if that's, we'll fund at 80% of cost, which we perceive as 65% of value, as cap rates have remained effectively compressed, but as rates have risen, the question of what is the validity of having that takeout lender there on the back end is what they're looking to pencil into. And so,
Are they extending out then on the debt fund? Will they, what used to be maybe a 2 to 3? Are they looking, hey, to get more of this funds out, maybe we need to have a 5-year window? It's offset, as we talked about before off camera, was just the rent growth has been there. So it's from the income side, it's there. It's just a matter of, is there a takeout at that, maybe it's going to take a little bit longer.
Sure. And that's kind of the $1 million question is what will happen with rates in the near term.
Right.
The yield curve, which is the perception of where rates will be tomorrow, in 30 days, or in 3 years, is generally trending upward, but it's all conjecture. It's a guess as far as we think that we may have an increase in rates. And so, I don't necessarily know that debt funds or opportunistic capital is saying, well, we will give you more term, but maybe there are creative financing solutions therein, or a mezzanine lender or piece, or maybe a different equity group who could come in to fill the gap if needed. Yeah.
So then you also brought up about banks, about the increase in volume on the regional, portfolio type banks. Is this we were joking in the office a couple weeks ago. It's kind of like their golden age. Like now they finally get to play Fannie and Freddie, or kind of price themselves out. Insurance companies, if it makes sense, they'll do it. Debt funds are having some things they've got to work through. So now their banks are in. What are you seeing with them? Are they able to get more creative? Are they kind of staying to where they were last year, but now their terms are more in play with where the market is?
Good question. One of the big differentiating factors I see between banks and other balance sheet lenders is a life company, for instance, prides themselves on not needing a personal recourse guarantee. Right. They're looking at the value of the property as their collateral. That stream of cash flows from tenants are what backs and pays for the loan. A bank, on the other hand, a larger money center group who you would see on almost any corner in mainstream America, they, as a balance sheet lender, are typically looking towards a recourse guarantee.
Exactly.
So they're saying, look, you, Greg, are going to be backing this loan. We are both incentivized for you to ensure this gets paid back because we know that you're going to be there. That said, some banks are able to offer non-recourse, so no personal guarantee, but they do have discretion with the pricing of their capital. They're not following either the treasury rate market or the bond market up and down. So if they want to say, okay, we're going to hold rates at 4.5 until somebody comes in and tells us otherwise. But as well, the banking group that you may work with, if you're closing on a multifamily purchase, is one small arm of a much larger group who is obviously doing deposits and focusing on other aspects of the market. So at the end of the day, their pricing has, all else equal, stayed probably anywhere from 50 to 75 basis points within life companies, all else equal, just based upon the way that life companies have followed. Typically it's not just we're going to price based off of a certain treasury index, but also what's happening on the corporate bond market.
Right. There's a little bit more play than just looking at what the 10-year yield is and saying that's where my rate's going to be.
Exactly. So it's a bit of a wrinkle in the market right now.
Okay.
But that's what we try to find is if there is an opportunity, how do you match up that lending partner and opportunity with whatever the buyer or the owner, if they're doing a refinance, is looking for. There's really no one size fits all.
So which brings a good point in terms of from a borrower standpoint or looking to get a loan either on a refi or purchase. One of the advantages on kind of going to like a group like yours is you've got relationships with various lenders, various type of lenders, because again, one size doesn't fit all. And I think in this kind of market that's kind of changed, you really need somebody in your corner advocating for you in terms of what's out there and what's going to be the best fit. Kind of shine some light on how if a borrower comes in, what are the questions you're asking them to decide, okay, what box do we go look at?
Yeah, and the reason why borrowers come to us is they may have a relationship with a couple of banks, a credit union or two. Maybe they worked with a fund that has helped them through a kind of opportunistic acquisition. They're enabling us to use our relationship with our lending field. So far year to date, we've closed with about 115 different lenders. But of that 115, with each of those transactions, we're taking out any one request to 5, 10, 15, 20, 100 different groups. So the questions I'm asking a borrower are, A, what will your ideal loan look like? And sometimes that's a bit different on the front end with the way that they request versus what ultimately they decide on in the back end. But for instance, if someone says, I'm going to come in, hold it for a couple of years, we're going to work on the property, add value, raise rents, and then probably move on to something else, that may not be a fit for a long-term type debt placement versus something that maybe has a shorter term with a step-down prepay, for instance. Also, if it's I'm sure you've seen plenty of institutions that were formed and they raised capital and went out and bought and renovated apartment complexes. Maybe you don't have an individual who says, I'm willing to sign on the carve-outs as a guarantor. Well, in that case, we're really truly looking for a non-recourse execution. So just in conversation, you can kind of understand where in the market is this placed. Is it a long-term solution? Is it a shorter-term one? Is it one where you have a recourse guarantee? But we also do construction financing as well. So there's a lot more nuance to that, whether it's in multifamily or other product types. But it's about finding the best fit in relationship.
And are you finding, just back to the multifamily, is in 22, has it been more purchase loans? Has it been refi? Has it kind of been even? Or where's that changed versus 21?
Well, at 22 on the whole, I think the banner headline is, loans are getting done because people need financing, not because they want it. If your rate's high 2, low 3%, you're excited, great, I'm locking this thing in for 10, 15, 20 years. My wife and I refinance our home. Our rate is in the high 2%, fixed for 30. That's obviously a very different product type, but 20
that might keep you from moving though.
Yeah, you're absolutely right. 22 year to date has been, a number of 1031 buyers who have sold other properties, looking to either invest in the same or a different market, and needing financing to match. Or there are always those maturities, whether it's a 5-year term, originated 4.5 years ago that's coming due, or maybe a decade ago from a CMBS loan that needs to get paid off. That's really a lot of the transactions that we're seeing, or potentially some projects that maybe were acquired a few years ago and are stabilizing, and they're looking to pay off that shorter-term bridge capital.
Gotcha.
So that's really kind of a balance of what we're seeing today. It's less looking to just do a straight rate and term refi, and more refinancing. There's
something behind that that's
purpose.
driving this. Yeah, it's just not, hey, great, the rates are low, I'll just take this one. So
correct.
Well, thank you for taking the time to chat with us today. If you want to learn more about Charlie's firm, just go to the website below. And again, we'll continue to have kind of financing updates throughout the year with this. With the market that we're in now and kind of I don't want to say uncertainty, but it's different. It's a change of where we were last year. Again, it's not like 2009, 2010. That was more of a credit crunch. But things have changed, and so it's good to kind of keep your get an idea of what's going on in the market. So again, thank you for coming.
Of course.
And we'll see you next time on HFO TV. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.